Well, welcome everyone. Thanks so much for joining us today for part of our Chalk Talk speaker series. Today our topic is SPACs, or Special Purpose Acquisition Companies in Sports. I'm Vince Genaro, the Associate Dean of the Preston Robert Tisch Institute for Global Sport at NYU School of Professional Studies. And I'll be your host and moderator for the next hour as we discuss this topic. And I want to introduce our outstanding panel for today's discussion. First of all, we have Brendan Coffey, who is the sports finance reporter at Sportico. And prior to joining Sportico last June, he spent years writing about business, markets, and innovative thinkers. His prior stints include serving as founding senior reporter for Bloomberg News' Billionaires news team, reporter for Forbes magazine, commodities and bond reporter at Dow Jones, and freelancer for Fortune, Esquire, Barron's, and the Washington Post magazine. Brendan is a graduate of Boston College with Phi Beta Kappa honors. Also, we have Leon Wagner with us today. He's the principal of LW Partners LLC, his family office. And since 2016, Leon's been a very active participant in this rapidly growing SPAC market. He helped create One Spa World, Whole Earth Brands, along with other SPACs. The skills and relationships that Leon's developed over his career are all the kinds of skills that are required to be successful in the complex SPAC market. Prior to launching LW Partners, he served as founding partner of Golden Tree Asset Management LP from 2000 to 2010, which grew to a 12 billion assets under management when he retired from the firm in 2010. And this, of course, followed a lengthy successful career on Wall Street with firms like Drexel Burnham, CIBC, among others. And Leon is a BA from Lafayette College and an MBA from the University of Chicago's Graduate School of Business, where he and I met too many years ago. And finally, David Abrams, who's a clinical assistant professor here at the NYU Tisch Institute for Global Sport. And he's also a banker at Inner Circle Sports. David brings 35 years of experience in investment banking and advisory services for public and private investments across all major sports and predominantly facilities. He advised in the development and funding for several NFL stadiums, including new stadiums in Atlanta, Houston, Tampa, Jacksonville, and Miami. Earlier in his career, David spent time at Jefferies, Merrill Lynch, Morgan Stanley, Bear Stearns, among other firms. He has a BS from Wharton and an MBA from Northeastern University. So I'd like to make a few comments and really set the stage and context for today's discussion. A little bit about my background. I head up the Tisch Institute for Global Sport, which consists of 3 degree programs, about 450 students. We have both graduate and undergraduate degree programs in the sports business. And we are a global leader in sports business education. I also host a weekly radio show on SiriusXM on sports analytics, consult with professional sports teams. And this, of course, follows my lengthy career at PepsiCo, where I was president of one of our beverage divisions. So let me start off by, since this topic isn't familiar to everyone, let me start off by defining what a SPAC is. It means special purpose acquisition company. It starts with a group of investors getting together, including 2 frontmen, typically a chairman and a CEO. And their goal is to raise money in an IPO in order to buy or merge with another company. Now, SPACs are often referred to as blank check companies because they're raising money largely on the basis of the reputation of the leadership and a belief that they will find a private company where they can create value by being part of the equation. But there's a lot of important nuances about SPAC, about how they work, about how SPACs work, and we'll get into these a little bit more in a moment. The initial investors or sponsors invest their money. Initially, they invest it risk-free. The reason they invest it risk-free is you can opt out and get your money back right up to the point where the deal and terms are declared. You also receive warrants in some unknown company that allow you to get additional leverage on the value that gets created. And in terms of what's in it for the acquired company, well, access to capital to grow that would not be available as a private company. and monetizing the value you've already created, taking some money off the table for the business you've built to date. You also get to go public without the expense and distraction of a public filing yourself as a small private company. And then finally, it's also a creative way to bring in accomplished leadership talent from the Spac, the chairman and CEO of the Spac, that can add to the value of your company. So with that, I'd like to set the stage on where we are right now. So for perspective, the reason we're doing this session today is in 2019, $13 billion was raised via Spacs. Last year, $83 billion came to market via this financing vehicle. So 13 million, 83 million last year. This year through today, we are on pace to potentially raise 360 billion via SPACs. So if you really want to understand the markets and including what's impacting the sports business today, you really need to know a little bit about this important innovative financing vehicle. So with that, let me start with Leon and ask Leon, what inefficiency in the capital markets is SPACs addressing?
Thank you, Vince, and it's nice to be on this panel. Vince, you did a very good comprehensive introduction and touched on what is really the key reason for that SPACs exist, which is to provide capital to middle market companies. So, you know, we're here today, February 17th, 2021. A year ago, the market was really non-existent, as you said, you know, probably approaching 20 billion in size. And middle market companies had a difficult time accessing capital. The IPO business is pretty much of an oligopoly controlled by Goldman Sachs, Morgan Stanley, JP Morgan, and a few others. There are private equity firms that, you know, provided capital. But until people started to understand that instead of going to 3 banks or 4 banks or 10 private equity firms, the owners of private companies have the ability to approach hundreds of entrepreneurs with capital who are looking for good managers, you know, with whom to partner. So the inefficiency is access to capital. In many ways, the SPAC market has become the democratization of capital, you know, not unlike the high yield market was in the late 1970s and early 80s. And it's grown into a frenzy. And I don't use that word, you know, to be negative. It's capital is there. Interest rates, you know, are at zero. So what's really, you know, one of the keys driving the growth of the SPAC market, and I'll end with this point, is that the SPAC market is finally starting to get a small percentage of the trillions of dollars that are sitting in money market funds yielding zero. And investors are saying, well, you know what? The 2-year yields 15 basis points. I'm willing to take 2 years of risk, take an equity, you know, kicker, and see how it goes. If everything goes wrong, I'll get my money back. If everything goes right, maybe I'll earn a return.
Yeah, yeah. David, would you like to add to that?
Yeah, I just think, and thanks again, Vince, for having me. I enjoy doing these. It's a lot of fun. And I always see the list of people are usually a lot smarter in the attendees than I am. So I'm always interested to hear what they have to say. I think that we're in the perfect storm. Like, you know, like Leon said, you know, there's cash on the side. You've got so much cash sort of pent up, looking for places to invest with interest rates at historic lows and continuing to sort of hover in that direction. With the problematic side of doing an IPO and the timing and the expense of doing it, this is, you know, this isn't the first time we've seen SPACs. I mean, this is probably the 3rd generation of these They weren't always called SPACs, sometimes black box deals or blank check writing companies. But I mean, this is a time where there's an extraordinary amount of transactions out there and cash that makes it valuable to do it. And I think that, just the idea that, price discovery is available in a way that probably you wouldn't have in an IPO. You're looking at negotiating transactions with sophisticated counterparties where they can come together in a pretty fast way to get something done, and a lot lower restrictions. So I think the regulatory environment is also pretty good.
Yeah, that's an important point too right now, and that could change over time, but for the moment, that's where we are. Brendan, do SPACs address this issue that IPOs often tend to leave money on the table? I mean, we see the surge in stock prices that we tend to see once an IPO comes to market. Not every IPO, but many of them. So, in a way, is that another inefficiency in the market, perhaps, that this is trying to capitalize on?
Yeah, I think so. I think so. And it's, I'm using Jay Ritter's out of University of Florida, his data here. But last year, the average IPO, traditional IPO, saw a 42% price gain the day it started trading, which is works at about 200 million an IPO, and that's 200 million and the average company left on the table. And I think that's been a long complaint of companies back to the dot-com days for sure, where you would just see these tremendous price gains after the public offering, and all these executives would feel almost maybe like they got cheated, that they didn't get the right price.
Yeah, and Brendan, you've written a lot about on Sportico. You've written a lot about sports enterprises and sports owners and individuals, some of which aren't doing SPACs for sports properties. Okay. But you've written a lot about what's going on in the sports industry with respect to SPACs. Talk a little bit about what might be, I don't know if it's fair to say, unique about sports, or what is attracting SPACs to sports and vice versa.
Well, there are a few things at play. I think sports fit nicely into a growth narrative, in the sense that there's a lot of disruption in media these days, the way people consume entertainment, and sports are one of the most compelling draws for consumers, and that people will still watch it live. They'll watch a game live. I think that's one. I think in the United States, there's also a great expectation that sports betting is just going to continue to expand, right? You're seeing it in New York, was long opposed to it. Now they're talking about it. Same where I am in Massachusetts, and then you see that in a lot of states. So I think it's really appealing to investors and sponsors, the SPACs, for that reason, to bring a growth product to market. On the sports side, on the sports owners, sports team side, we'll probably get into that a little more. I think it offers a lower key way of marketing their company and getting a price for it, right? They can negotiate privately, whereas with an IPO, you have to have a road show, you have to run between cities for a week or two, and really try and make nice with a tremendous number of investors. And someone like say John Henry of the Boston Red Sox, he's not going to want to go running around the country for 9 days hawking Fenway Sports Group. With a SPAC.
So Vince, could I just add? So it's a very interesting point, Brendan. And for the group, I was very fortunate to have been part of the Milwaukee Brewer ownership for 11 years. And when it was time to go, there was only one place to sell, which was to the ownership group. Franchises don't have transparency in price. And I think what's really, not generally understood is that franchises are generally not owned by one individual. They're owned by consortium, by partnerships, and things like that. So I think, as the values increase, you're going to see pressure, from all sides. One, as Brendan said, they're going to want to recognize those values. Two, I think for all of the, stakeholders, they're going to want more transparency. Although, Vince, I would defer to you, as to whether you think owners would view that trade-off as, do you want your business known, or would you rather have it, in the public eye? Because there is obviously the glare of the public markets there.
Well, yeah, and I think there is some concern by leagues that that the full economics of a team financials could be unraveled through that. But if you talk about something like Fenway Sports Group, where they have a stake in Liverpool and a stake in multiple entities in their sports business, if the deal was structured to include all of that, I think it would in fact mask some of the economics. Not that I'm advocating to mask it, but I'm just saying I think that would be the league's the league's preference. David, I wanted to ask you, and feel free, of course, to comment on what we've already asked, but I wanted to ask: is there a sweet spot in the amount of capital that a SPAC is sort of either as an acquisition target, a sweet spot, or in terms of a capital raise? I mean, I've seen them everywhere from 150 million to into the billions.
Yeah.
But what is the sort of sweet spot?
I think in the sports world, we've been seeing they were all in the 200 to 250 million range in the first go round, and now we're seeing ones that are in the $1 billion range as they start to stretch to different products and different sort of areas in the ecosystem of sports. I don't know that there's a sweet spot. I think that you want to look at what you're likely to acquire, and based on what you're likely to acquire, maybe a 5 or a 10 to 1x is what you're looking to raise. And again, it's really what the acquisition looks like. I think it's interesting that having a plan, and you can't really advertise that plan in a broad way in the on your registration statement, but having a plan of what you're looking at, I think it provides some healthy certainty to your management team. What I like, Vince, is that you mentioned about, okay, if, as a sports team going public, I don't know that we all have a lot of comfort that the people who manage our sports teams are the right people to take a sports team public, right? They're not the management company. Here now you're taking sports assets that maybe people have grown as Leon said, a limited partnership or a group of individuals that have a like mind, and you're putting it together with professional management. And I like that. That's a really interesting combination here. And you can go, and maybe I'm taking in a direction you're not wanting to go, but I think it was reported in Sportico that Colin Kaepernick's, the one that he's involved in, is really environmental and social and governance Spac, right? So you can have mission, I think they call theirs mission-driven space. Maybe I'm taking that right out of Sportico. Maybe Brendan, that's something that
mission advancement.
No, but that's the name of his space.
Oh, sorry.
Sort of a mission-driven space, and I like that. So Vince, the size has a lot to do with what you're trying to accomplish, right? But
So then I think Dave and Brendan really hit on a lot of points here. Just to take it just away from sports for 1 second and just talk about the general SPAC market. In the general SPAC market, I think David's right on. The sweet spot is 250, I would say maybe to 400 million. And those are those sponsors will be searching for businesses in the $1 billion area, plus or minus. What we're finding now in the SPAC market is it's actually easier to get larger deals done than smaller deals done. But the one point I wanted to make is that what is shocking to me is how large and vibrant the private middle market industrial base is that this market is applicable to. Every day when mergers get announced, it's often companies no one has ever heard of that are worth $1 billion to $2 billion.
Well, yeah, and on the other hand, there's a little bit of fear in that too, for the way you just expressed it. Companies we never heard of that are worth that much. Some of that I'm sure is quite legitimate, and value is going to be added by the acquiring SPAC. On the other hand, it does raise the question, with all of this money, let's say 300 billion comes to market this year, 4 times what it was in 2020, which was, 5 times what it was the previous year. Where does all that go? And does that chase and bid values up?
I just heard one point that bears, I don't know if we talked about in our previous conversation, but remember that the number of public companies has shrunk dramatically over the past 10 to 20 years. Somebody remarked the other day that the Wilshire 5000 no longer has 5,000 companies in it. So in a lot of ways, this is a reversal of what had previously happened. But I will defer to David and Brendan.
Yeah.
Go ahead.
Brendan, go ahead. You were going to say something.
Oh, me? Oh,
Yeah.
well, yeah, the Wilshire 5000 is about 3,500. So we've lost about 5,000 public companies in the past 20 years. So there is that. I will say though, that a point you made just a second ago, Vince, is yeah, I am hearing about some shopping around for better bids. I know there are some businesses that people are hopeful, sports related businesses people are hopeful will come to market where their venture capital investors have gotten their desired bid from a Spac and have said, well, you know what, there's so many out there, let's see if we can get another 20, 30, 40% more. And that's going on too. So
yeah. Well, what's interesting is that I should have mentioned this, is that one of the rules of the Spac process is the members of the Spac cannot engage with a target company until they file. Did I get that right, Leon?
Yes, you're correct. No pre-identifying.
No pre-identifying. So you can't send signals out there as you're filing your Spac, which could sort of juice your ability to raise capital, because that's not part of the process. There's a whole set of interesting, I don't want to say contrived rules, because I think they're all there for appropriate protections on different sides of it. But there are a set of rules. Leon, you were going to say something.
Well, what I was going to say is that, and Vince, you mentioned this at the beginning. Once again, the sponsors put up risk capital of, let's say, 2.5% to 3% to get a Spac listed. The public Spac IPO investors buy a unit comprised of 1 share of stock and a fractional warrant. Their stock, which they pay $10 for, goes into a trust account in the bank so they can get their money back. So, so what is the point I'm making? The point is that there are a lot of, you called it bells and whistles, I would call it more checks and balances, which is to get a deal done. You normally, when a Spac and a private company agree to merge, institutional investors are brought in to do what is known as a PIPE, a private investment in a public equity. So that's one validation where these investors, who include institutions like Fidelity, Franklin Templeton, Barron Capital, very sophisticated, T. Rowe Price, they have to agree on the price. That's the first thing. And then the stock is constantly trading, and that's really the barometer of the public's view of whether the transaction makes sense or not. Because if it trades below net cash, investors will say, well, just give me my money back. Now, I think that there's no doubt that a lot of enthusiasm can be whipped up. And there's an old saying on Wall Street that securities are sold, they're not bought. And there's certainly quite a bit of selling going on right now.
Yeah, but Leon, to your point though, that while this is trading in the public market, it starts out trading before the target company is identified. So you're really at some point you're investing in the management. Right now, Marquis Rain, right, is Tom Ricketts, the owner of Chicago Cubs, and Rain Capital. And so right now that's out there trading. Red Ball, which might be familiar to some of our people, which is Jerry Cardinale from Goldman and Billy Beane, right? So that's out there trading. But we don't really know until they get a deal what they're, but those stocks will fluctuate each day, as will the
It's
warrant price.
interesting. The validation in that is the private equity investors, like Seth Klarman from Baupost, who's a part of Fenway Sports Group, is also bought a big piece of Red Ball. So, I mean, you're looking at the validation of the business model. They won't all be perfect, as we talked in sort of our pre-meeting. I mean, there'll be some that don't work well, right? But you have the opportunity now to roll up deals. And so it's not just, you know, the SPAC acquiring one or merging with one company. Sometimes it's with two companies of a like mind, and they're creating something that, you know, that looks like the roll up from 10 or 15 years ago of similar companies.
So Vince, just to just put it in a way for the people who are listening, and for those, just as a way to think about it, to your point, yes, management teams that are perceived as being good management teams who will find good deals will trade at a premium to net cash. Net cash really is the put that, you know, the investor has to go back to that trust account. So when you think about this, I think the right way to think about it for everyone on this call is, what kind of premium are you willing to pay for a management team, knowing that your downside is I can always put it back to the trust account and get my money back?
Yeah.
What, about $10? And these, most of them are around $10 right now.
Right. But to Vince's point, I don't know where these high quality SPACs with the Ricketts and Bean, et cetera, are trading, but they're trading at premiums to cash of 0.2, maybe 3, right, which starts getting expensive.
Yeah.
And not only that, we've seen a sort of proliferation of ETFs that are, if you are afraid of buying something just to bet on management in hopes that they'll find an acquisition that is appropriate and drives the price up, you could buy an ETF that looks at a lot of different SPACs. Those are, I don't know, you'd have to look at each one as to see where they're trading versus the net cash value. You have to look through the prospectus on that.
You know, there's one point though that David is really worth mentioning here for everyone, which is, once again, there is the pre-merger SPAC, at which point, you know, you can put it back to the trust account and get your money back. And then there's the post-merger SPAC that is really a middle market company. You know, my understanding is a lot of these ETFs hold on to the SPACs and become, in essence, middle market equity funds. There's a lot of risk in that.
Yeah.
Yeah. So Brendan, let me ask, oh, by the way, I should have mentioned earlier, for those listening, please type your questions into the Q&A and we'll get to those in just a bit. Brendan, is there a demonstrable track record for SPACs today? I mean, you know, and I know they've been out there since 2012 or even before that, but it feels like with this recent surge, it's so young and so new that it's even hard to go back and say, well, here's the average track record of a SPAC.
Yeah, it is. It is. And kind of to what Leon was just saying, if you kind of divide it into two parts, there's the post-IPO pre-merger SPAC. Those seem to return really well for investors if you buy the units or the shares or the warrants. You know, after the merger, the jury's is more out. I think it goes back to management quality and quality of the deal. You know, because when you go back farther, you know, before 2020, 2019, you know, the tendency was for a lot of SPAC deals to be lower quality companies or value plays, and where it's really shifted to a lot of growth stocks, growth industries, and with much better management all throughout. So it is hard to judge.
Yeah, yeah.
Oh, go ahead. You got it.
No, go ahead.
I was going to say, I took a look at, you know, a bunch, you know, several of the SPACs that have been announced and looked at what they're trying to acquire, right? What their business plan was. And so, for instance, Arctos's SPAC was looking at teams, leagues. I think they put teams and leagues in there just to get people's interest up, but I don't believe that that's going to be the case. I just don't know. But data, tech, digital infrastructure, health, wellness, esports, and gaming, a very broad swath.
That's very broad.
You can imagine it's more going to be the latter group of that group. And then John Ledecky, who is partner in the Islanders, data-driven companies. In the most recent one, I think they've done maybe 3 or 4 that they've come out with. And so most of the ones that I see recently seem to be focused on the ecosystem of sports, but along the periphery of where they see growth. Like sports teams and leagues are pretty full valued right now, but you have a large growth potential in data analytics, in gaming, in esports, maybe, well, you know, in the areas that just haven't seen the tremendous amount of capital flow into. And this is the opportunity to put that capital work in growth areas. So.
Well, you're right. It makes more sense to go where the disruption is. And, you know, sports betting would be another good example. And, you know, one of the things we know about leagues and teams is they're not really in the market for growth capital generally.
Exactly.
And you've got a steady state operating model. You can't expand. The Detroit Lions can't expand out of Detroit, right? So there's a little bit of a fixed proposition there. Leon, you were going to say?
No, you hit the nail on the head. In Spacs, two of the major reasons that private companies merge are owners want to take a little money and off the table, but 2, more importantly, they want to get growth capital. And in preparing for this, to your point, I was wondering, where is the need for growth capital in the franchises? Now, certainly Harris Blitzer, figured out a way to do it, and others are exactly as David talked about. So there are ways, but are there synergies? I mean, these guys are very smart, and they're finding ways to deploy the capital.
But it's not in the team business proper. It's in the adjacent spaces, right, Brendan?
Well, yeah, mostly. But you are seeing. I mean, Fenway Sports Group is the first that we know is negotiating to go public by Spac with Red Ball.
Yeah.
That didn't happen because of valuation pushback from the PIPE investors. But yeah, you are hearing of sports organizations exploring Spacs now. I think teams themselves face a what's the story they sell to Wall Street? Are they a value play? Are they a growth play? I mean, when you boil it down, that's essentially what you sell to investors. And I personally, I just don't know where sports teams fits in that.
But Vin, it occurred to me, and we never just talked about this in our discussions, but I mean, correct me if I'm wrong, Madison Square Garden is public, right? And the Rangers and the Knicks are public.
Right.
So how has that worked? I'm just saying that, obviously it's worked for the Dolans and I guess the shareholders.
Yeah, I mean, Brendan, that would be something for you to comment on.
Well, yeah, I mean, the Dolans have been great about creating shareholder value, if that's what you're focused on.
More than W's.
Yeah, for sure. But the enterprise value or the market cap, let's just say, of the Madison Square Garden Sports, which is the owner of the Knicks, Rangers, and a couple of G League teams, is well less than what people say the Knicks would sell for in a private sale, just themselves, right? If Madison Square Garden is, I don't have it in front of me, but somewhere around maybe a $5 billion market cap or enterprise value. Yeah, everyone says the Knicks Sportico, we just value the Knicks at well more than $5 billion. And everyone's, people say that Rangers would go for over $1 billion. So there's certainly a discount there in the public market.
Yeah. One of the things that I'm curious about is that I want to better understand the relationship between SPACs and private equity companies. So, on the one hand, we see private equity companies doing SPACs. On the other hand, we could see private equity companies using SPACs or blending with SPACs to exit some of their private capital investments. Talk a little bit about this almost odd relationship and how it fits together in the capital markets.
David, you want to start?
I'll just start. I mean, I think that it's essential to put a value on an asset. And so private equity, you started saying it, Vince, is that the private equity firms like the Pacific Group and Silver Lake and Apollo, I mean, they own a lot of assets inside their portfolio, sometimes in Blackstone that there's no liquidity to it, or there's no value that you can ascribe to it other than a negotiated value as an arm's length transaction. This puts value on it. It adds liquidity. And I think that most investors want to know that there's liquidity to what they own. There's an exit strategy. And it's not, when I say exit strategy, that's maybe has a bad connotation for people that are listening, but it's really, if you want to sell a piece of the asset, this is a way to do it. And it's fast, and it makes sense, and it's an efficient way to put value on it.
So Vince, so to your point, that it clearly, in my opening remarks, I said that, there was an oligopoly of sorts in the IPO underwriters and also in the private equity world. Well, if you're a private company that wants to totally exit, cash in, and call it a day, you'll go to an investment bank, you'll ask them to get the highest bidder, and that'll be it. If you're a growth company that wants to take a little money off the table, access growth capital, and wants to merge with somebody like Billy Bean or Cardinale or somebody like that, where they will add value, there's that. In a lot of ways, I've been thinking that the immense growth of the SPAC market, is not only driven by the fact that Wall Street earns significant fees on it, but I'm thinking in a lot of ways, it's a referendum that private companies are basically saying, we prefer SPACs to private equity, generally speaking, right now.
Interesting.
Yeah, I think just to add to that, I think that's a good point. I think a lot of private companies, for instance, have owners who don't want to sell, but have investors, friends and family who need to cash out. And up until now, they haven't had great choices, right? You can go with private equity and give up control, or merge with a larger company like Ben and Jerry's did, just simply because they have to cash out some of their early investors who need the money.
Leon, in a conversation that we had, you once said to me that in some ways, this innovation of SPACs reminded you, going back to the high yield days, when your days with Drexel, Burnham Lambert, with Mike Milken. Talk a little bit about any parallels you might see, and on what level is it similar?
There's a lot of similarities, Vince. In the late 1970s, unless, I used to say, if you needed money, you couldn't get, they wouldn't lend it to you. If you didn't need money, the banks would lend it to you. There was a small group of banks, and Mike Milken figured out that there were a lot of people out there that had good ideas that deserved to get financing. And let's just use an early example. Bill McGowan, who created a company called MCI Communications, which challenged AT&T's long distance monopoly because they had such, margin in their business. And in 1979, MCI raised $15 million. In 1980, MCI raised $30 million. In 1981, MCI raised $125 million. Then in 1983, they did two separate $1 billion transactions. So it was off to the races. And Milken used to call it the democratization of credit, which was investors are going to judge you on your ideas and your execution, not on the traditional things. So that is a lot of what's going on in the SPAC market today. Vince, I just want to take 1 second just for the benefit of, I think a question that many people might ask is, well, who are these managers, who are sponsoring all of these SPACs? And there are a lot of people out there that have decades of experience and relationships and knowledge, who have gotten into the point of their career where it's very valuable, but maybe they don't want to go into work every day, and they can help in some other way. That's kind of the, I would say kind of the general description of what a SPAC sponsor looks like these days.
And Leon's point about the high yield market grew out of serving an underserved market. I mean, there was a need, and if you believe in sort of the efficient market theory, this is really, the SPAC market's growing out of serving an underserved market. That's all it's doing. It's stepping into a space where there was heretofore very hard to raise capital, and now you found there's a way to sort of push capital in a direction where there's a need. That's all. I mean, it's pretty simple. I don't think, I think that the capital markets tend to be a mystery to a lot of people, but it's typically simple. Money moves in a direction where there's a need. It's always, that seems to be the direction things work.
Before we get to the questions, I wanted to bring up the possibility of regulation in this area, whether the new administration, we think, will impose any higher level of regulation on SPACs. Are the benefits that accrue to the sponsors perceived to be too lopsided? In fact, we have a question we'll get into on that cites some research. But what are your individual thoughts on this?
Vin, once again, an IPO is an initial public offering that has to go through a lengthy SEC process. A SPAC is a merger between a private and a public company, which is shorter, and in which, in the proxy materials, projections can be put in for 2 years, maybe 3, wherein an IPO prospectus, it cannot. If you asked me, and that's very attractive to investors, they get to, more perspective. But if you ask me my gut reaction, as you're correctly saying, if 300 billion gets done this year, which I kind of think there will be a bump in the road somewhere along the way, there always is. But if the regulators were going to do something, I'm not sure they would restrict SPACs in some way. I think they would probably enhance the IPO process, but that's just one person's opinion. I don't know.
On a related point, I want to get to this interesting question here by Daniel Sherman, who's an attendee today. I'm going to paraphrase it, but basically, how is it possible for a sponsor to reconcile the morality of promoting an investment tool that's far more risky for the shareholder than it is for the sponsor? The article that this is a product of research by an NYU law professor and a Stanford University study, and the average SPAC stock sank by 36% a year after the merger, yet the SPAC sponsors pocket an average of a 400% return. So how do you, and is that something? You're nodding, Leon, go ahead.
No, I'm saying I think it's absolutely an appropriate question. But the investors that we're talking about, have chosen to elect to stay into the merged company. They could have elected to redeem. That's the first thing. The second thing is that the notion that the SPAC IPO investor takes more risk than the SPAC sponsor is actually not accurate. If a SPAC is not completed, the SPAC sponsor loses their entire investment. If a SPAC deal is completed, then they will earn, a return on that. And what it has evolved over time is that investors have become much more, have sharpened their pencils, much more aware of the economics to the sponsor, and much more willing to demand that sponsors give up equity, give up warrants, reduce their promote, et cetera. But at the end of the day, it was what Brendan and I were talking about. There's the pre-merger SPAC, there's the post-merger SPAC. If you're playing in the post-merger SPAC, you really have to be aware of what you're investing in. And I would say, to support that Mr. Sherman's question, there is definitely a tremendous amount of speculation out there right now. And there is a lot of, whiffs of 1999. And it is a time to be cautious.
Yeah, and I think
you were going to say something?
Go ahead, Brendan, you go.
Oh, well, yeah, I mean, I was going to say there's that, it's that sponsor risk, I think, right? That 2 to 3% of the ultimate value you want to raise, that is a concern for me. I think that creates an incentive to get any deal, no matter, like, the last thing the sponsor wants to do is to have to hand the money back and book that loss. So, I'm not gonna point out specific names here, but you see some post SPAC mergers where the company's trading at $2 now or $3. Obviously, that wasn't a good deal, but the sponsor was able to make that happen, to at least try and recoup some of their investment. So I think there's an incentive.
But in the pre-merger phase, if the merger then occurs and I'm offered the opportunity as a public investor to get my money back or not, it's very possible that I'm going to be drinking the Kool-Aid at that point. First of all, I don't have access to the information that the person selling the story to me has. And I don't know if I stayed in that long and I got excited about the company being bought, I guess I realized the onus is on me, the investor, or any of us, the investor, to do our due diligence to make sure that we want to be in this deal at this valuation. But it's seductive, I guess, is the word I would.
You know what, Vince, you just did say something that I think that we all did that, leads to the conclusion of, might regulators look at the issue of projections as something that might be, they don't exist in IPOs, they exist in SPACs. Are they realistic? Are they misleading? I think that is a fair question.
Well, that's interesting because that is one of the things that people speak to is that you get forward guidance in a SPAC. You don't get that in an IPO. But if it's a fallacy and it doesn't help. You were going to say something, David.
I was going to say that, there's just a lot of capital chasing all of the same deals. And so it's not necessarily just a negotiated merger. There might be a company out there looking, with a term sheet out to 3 or 4 different SPACs looking to purchase that company. And so you tend to see maybe the push of inflation on prices. And I don't know, Brendan might be right. There may be this pressure for the financial sponsors to do a deal when they get to the end of their 2 years. But there is going to be upward pressure on businesses, on valuations, and that in itself, you have to be very careful as an investor.
Vince, somebody recently pointed out that there's a little bit of a virtuous circle going on here in the following way, which is a merger is negotiated, institutional investors commit to a pipe. They don't put their money up until the transaction is going to close and all the conditions of the merger agreement are met.
That's right.
Now, what that means is that generally speaking, the SPAC public equity will be trading above its net cash. But that's a little bit of a virtuous circle, which is, well, investors are saying if it's good enough for Franklin and Fidelity, it's good enough for me. The fact of the matter is, in a more efficient market, there would be, more SPACs rejected. In this market, that's not happening right now.
Yeah. I want to get to a few more of the questions here. So what are your thoughts on A-Rod, Kaepernick, and other high-profile athletes creating SPACs? And obviously, everyone is an individual. It's hard to just generalize. People bring different things to the table. But, Brendan, what's your reaction to some of the athlete celebrity SPACs?
I'm not I don't dislike it. I think they're easy targets to say, well, they're just a big name. You do see some criticism about that. But, also someone like A-Rod, he certainly has a lot of money to invest, for sure. I'm okay with it.
Yeah.
Penny, are you asking us whether we like or hate A-Rod? No, I don't.
What can you share an example of your favorite sports brand or company that went the SPAC route and why?
That's an interesting.
Oh boy,
DraftKings, yeah.
Right.
Very
right. So
they really started the whole thing.
So David, it's such a great point. A year ago, January, every year, something called ICR, which is a consumer group, PR, et cetera, has a conference. And when DraftKings went public and announced their merger, the stock was at 11 or 12. You could have bought all you wanted. Nobody was really paying attention. Nobody really got it, until everyone, tried to pile on. So
If we hit a recession, well, let's just say interest rates rise, and the 10-year rises above 2% or whatever, and what happens to the SPAC market versus what happens to the stock market and equities in general? Do the SPAC market get hurt less? Do they get hurt disproportionately more in a downturn or pullback?
Look, the SPAC market is, if you've looked at market sell-offs as a money market alternative, the SPAC market is a provider of cash, to funds that otherwise maybe are, trying to raise capital for offset losses, much greater losses. Remember, there is downside protection in the pre-merger SPAC because you can always get your money back, from the trust account in 2 years. I've given this a lot of thought, and it's like, I think, most up markets and down markets. In a down market, volume, I think, will probably go down, but notwithstanding, if you're a private company owner and you're in a bear market, that doesn't necessarily stop you from wanting to seek liquidity, and maybe give you more incentive for wanting to seek liquidity. I'm not sure.
Mm-hmm.
And Vince, we've been in a 35-year bull market for bonds. I don't think, my personal opinion is it's not really healthy to have a 1.2% 10-year. That doesn't make a lot of sense. So when you look at the 10-year going to 2 or 2.5, to me that foretells a healthier economy. And so I actually think it's bullish for the stock market. People were putting money into bonds for the reason is there was capital appreciation and income. I don't think that there's much capital appreciation in all, well, you have to look at all the fixed income classes, but it's less and less capital appreciation and the returns are lower. So sure, as rates go up a little bit, you'll see more money head in that direction. But as the 10-year gets to 2.5 or 3, where the Fed would prefer to have it, I think you're looking at a much firmer, stronger economy in the United States and maybe globally. I mean, you have to look at all the large countries in their economies, but I think it's healthy.
Yeah. Here's another question. Can a SPAC be used to fund an owner's baseball operations? If so, what teams like the Red Sox and the Yankees are doing now? Is that what teams like the Yankees and Red Sox are doing now? Well, they're not using those funds today. Could they? I mean, they're still vulnerable to things like the competitive balance tax threshold on salaries. Could they, David, could they do improvements to the stadium though, that, and combine those with some public financing and enhance their operation that way?
I mean, I would expect that if a diversified sports entity sold a portion of their company into a SPAC, the proceeds of which would be providing liquidity to ownership, and they would use that in the highest and best use. Some of that may be improvements to the team, investing in capital. I don't know if it's human capital as much as maybe bricks and mortar. I don't know, but sure, why not, right? Yeah. Operations seems to be, that might be an issue. I would think it would be more bricks mortar, maybe infrastructure, technology infrastructure, and that kind of thing.
Yeah.
But Vince, once again, once the merger takes place, it's an operating company.
Yeah.
So however the cash in an operating company is used, that's right.
How it's used. Yeah.
Yeah, I mean, they probably want to use it too for related businesses, right? Real estate development around the parks is a big deal now, and I'm sure that's part of their thinking, capital for those sorts of things.
So as we wind down here, we just have a few more minutes. I guess I'd like to give each of you the opportunity to share some sort of parting thoughts on this really interesting topic. Why don't we start with you, Brendan?
Oh, sure. Yeah. Well, thanks for having me on. I appreciate everyone's time here. Yeah, I mean, it's a really exciting time. As someone who follows the markets and writes about them for sure. I just did a tally this afternoon of how many sports related SPACs there are. So ones that are sort of sports personalities, A-Rod and team owners and things of that sort. And there's about 75 now.
Wow.
Sports
Wow.
SPACs with
Wow.
27 billion in capital. About a quarter of that is sports specific, looking for teams or sports, gaming, betting. Yeah, but that seems to be a tremendous amount of money. And you do hear talk about some well-known organizations at least considering going public by SPAC. And so I think that the rest of the year will be really interesting from a sports perspective, for sure.
One of the things I forgot to bring up, and I meant to, and we've talked about this before, some of us, is that you've got this interesting convergence right now of, look, you've had a lot of income disparity, growing income disparity. So that means that the top of the, the top 1% has gotten even richer and deeper. So you've got more wealth built up at that end of the scale. Couple that with the aging baby boomers, people who have, made their tranche of money, they've had their entrepreneurial or corporate career or whatever, and now they've got all this human capital locked up in themselves that they want to put to use, and this becomes a really interesting outlet for that, as sponsor, as chairman, as CEO, as board member for these companies. This is the kind of thing that gets people, like us, excited. So I think I just think it's interesting that that's all happening right at this point in time, and certainly could be the fuel for the SPAC market to continue to grow. David?
I as a capital markets fan and somebody who works in that business, I like to see growth in various sectors. And it's really interesting to me to see how money moves around the globe and how people change the way they invest in sports, which is our business, Vince. And to me, it's great for our students. It's great for people who want to put a toe in the water. They can do it in a relatively inexpensive way to follow their favorite businesses and actually be a small investor in it. So I like that. I would counter that with the fact that, everything you do, you have to do your diligence on. To the best of your ability. You've got to be, read about it. Don't just throw money at something because you see like an A-Rod at it. That doesn't mean, money. It just means it's an endorsement. So I would caution people to make sure they're doing their diligence, but it's a great way to learn about the markets in a small way. And it gives the smaller investor the opportunity to be involved in things they might not otherwise have the chance to.
Yeah. Before we go to you, Leon, Brendan, someone asked 75 companies, somebody in the Q&A, and how much capital?
27 billion.
27 billion. Yeah. Leon.
I think David really made a great point, and I'm gonna just kind of summarize a couple of things that you guys said, which is, so the madness of the crowds, if you will, kind of started in the SPAC market when Richard Branson, took his Virgin Galactic public, which is space tourism. And how do you quantify that? How do you, now it's going to be maybe, Virgin Galactic over stadiums, let's go visit 5 stadiums in one night or something like that. But David said it correctly. There is, whether it's electric vehicles where, billions have poured in, the fact that you said that the Fenway transaction broke down over price disagreements, that's very healthy. I would agree with, the comments that Brendan and David made, which is, be careful. SPACs are an excellent vehicle as a money market alternative, but don't forget, if you don't like it, put them back to the, to the trust account, and don't get caught up in the insanity.
Well, terrific, folks. Thank you so much, Brendan, for taking your time today and sharing your thoughts on this topic, which you write about all the time on Sportico. David, it was great to have you on, and thank you so much for your contributions. And Leon, my friend, great to have you weigh in on something that you've been very actively involved in as a principal, and it was great to have this discussion. Hope everyone enjoyed it. This will also be available to send out once it's once we get the recording back. So hopefully you'll get a chance to share it with others and recommend it. Thanks again, everybody, and happy.
Thank you, Vince.
Thanks, Vince.
You bet.
Yeah, thank you.